How much money is circulating in our financial system right now? And what would happen if a large chunk of it was suddenly gone?
It does raise questions about who is it that will be buying treasuries.
President Joe Biden has signed a debt ceiling deal allowing the US Treasury to issue a large number of new bonds. This is essentially the government borrowing more money to refill its budget. But there's a twist, and it's all about liquidity.
What's it going to do to liquidity in the marketplace, and what could that mean as a practical matter? That money's got to come from someplace.
Liquidity refers to the amount of money available in the financial system. It's like the lifeblood of our economic body. Banks and financial institutions use their reserves and deposits to buy these new bonds, which could lead to a reduction in liquidity, also known as a liquidity drain. And this is a reason for the financial world to be concerned.
QT and the budget deficit with this new issuance on the other side of this debt ceiling deal now potentially being quite substantial.
The financial markets may not be prepared for this. The Federal Reserve has been running a program called quantitative tightening, which is already reducing bank reserves. This new bond issuance could worsen the liquidity drain and create a significant drop in the performance of stocks and bonds.
We still have that the Federal Reserve is doing quantitative tightening to the tune of roughly $60 billion every single month.
Picture this. The money that's usually used to buy or invest in stocks and bonds is now going towards these new treasury bonds. This shift could cause a drop in liquidity similar to the contraction seen during the major financial crises like the Lehman Brothers bankruptcy in 2008. It's a serious situation that could happen.
The problem with the debt ceiling being passed, I mean, it's good from a political perspective and good from a stability perspective. There's going to be a significant amount of issuance over the next couple of months.
So who's going to buy these bonds?
It's going to be a lot of T-bills. Do we have the buyers for those T-bills?
Banks, money market funds, households, pension funds, and corporate treasuries are all potential buyers. But the situation gets even more complicated when we consider that banks may not be eager to buy these bonds because they might get higher returns on their own reserves.
In the past 20 years, there have been 4 times that the Treasury General Account has had to raise significant amount of assets like it is this time. Each time it was able to do it without an issue.
Then we have non-banks. They might also buy the Treasury bonds, but they could cause a further drain on liquidity by selling off their bank deposits to do so.
Plus, also think about this. You're now getting interest rates that are almost in excess of headline inflation to be parked in T-bills, right? So it's just a very attractive investment for many investors.
In a nutshell, we're looking at a situation where this large issuance of Treasury bonds could potentially suck a lot of money out of the financial system, leading to a decline in financial market performance.
I don't think you're going to have an issue with it. The TGA should be able to be refunded with very little problems in the market.
No. So I take a slightly different approach. Reserves leave the system. That does put, that generally means that deposits are leaving banks. And that I actually think it's going to be a bigger impact on liquidity.
It's a complex situation with a lot of moving parts, and it is vital to keep a close eye on how things will evolve.